All right, ladies and gentlemen, transparency, what a word that is used in politics, it's used in everyday life, it's used in the financial services industry, obviously a word everyone likes or hates at the same time. How far we can go with transparency might show the following example that's happening very often in a private life, in private partnerships. The following sentence might ring a bell. Honey or darling, where have you been yesterday night? Is it too much transparency in private life? You can just say, I don't know. You can also split up if you want to. How it is in the financial services industry, what transparency stands for, whether it's going too far or not, that's what Dr. Hans-Joachim Jaeger will focus on during his presentation. He's partner tax financial services at Ernst & Young. Thank you.
Thank you. Yeah, if Dr. Gysi would have stayed a little bit longer, I would have told him I have two problems now. And this problem really relates to his pilot because he was delayed. And I know that he would be talking something about tax consultants and then consultants in general. And hoping for Mrs. Müller-Möhl just to water it down with the philanthropic issue a little bit. But that didn't happen. So here I'm standing representative of a consulting company and even worse as a tax advisor. Thank you for having me here talking about tax transparency. This is actually a topic, if you talk to banks, they will be prone to answer to this with a word that we have seen in this movie clip of Caroline Müller-Möhl. I think transparency really sparks emotions, and it really depends on who you talk about or who you talk with. These emotions can go high. I think in particular with the banking industry, they are now faced by a multitude of different initiatives, and it's not the number of initiatives, but I think the mere fact that these initiatives are not congruent, they are not reconciled. Every new initiative that comes binds resources within banks, binds resources within insurance companies, within asset management companies. So the thing that Switzerland is currently faced with is basically the QI system, which we have since 2001. And the Americans are very clever because they say by signing up for the FATCA agreement, you automatically enter into a new QI agreement, which will take place as from 1st of January 2015. Which puts another onus on banks, which are qualified intermediaries. Then the EU interest taxation since 2005, and the EU is sort of revamping it. They are rebuilding the EU interest taxation in order to also encompass information about dividends and other income. Then we have the final withholding tax, and quite literally or quite bluntly, I would have to say I think this Abgeltungssteuer or final withholding tax will be something of the past once the common reporting standard, once the automatic exchange of information has kicked in, because, as I said bluntly, I wouldn't see any kind of raison d'être for the Abgeltungssteuer once the automatic exchange of information is in place. Then we still have FATCA. I will lose some words about that. You think FATCA stands for Foreign Account Tax Compliance Act? That's right. No, you are wrong. It really stands for Full Employment Act for Tax Consultants and Advisors. I think just from that you can see that millions, hundreds, literally hundreds of millions of costs are triggered by these kind of initiatives, and this will carry on throughout the next years. And last but not least, we have the DOJ program here in Switzerland, and I think at least those of you who are working for a bank which put itself into the so-called category 2 will face a lot of work and will potentially face a lot of fines. But you know there is quite a little bit of rumor of banks opting out of this category 2 because apparently the Department of Justice in the US has issued this non-prosecution agreement, and it's almost unacceptable for the banks. So I think there will be quite a lot of discussion in the coming month. Currently, at least under FATCA, we have two different models, the so-called Model 1 and Model 2 agreement. Model 1 agreement basically says the financial institutions would have to collect information about their US taxpayers who are clients of theirs and deliver this information directly, deliver the information directly to their tax authorities, and they would forward the information to the IRS in the US. Under the Model 2 that we currently operate in Switzerland, the banks are collecting information about their US taxpayers and forward this information directly to the IRS. You may have heard that Switzerland is currently renegotiating this. Switzerland will most likely swap to a Model 1. And this is simply due to the fact that under the automatic exchange of information, this pretty much looks like Model 1. And I think now that the political sentiment and current sentiment in Switzerland is we need to exchange data, it doesn't make sense to have two different systems, one for the FATCA and one for the Common Reporting Standard, because, as I said, the automatic exchange of information will follow this path of the Model 1. The IRS will tell you we had a phenomenal success, because alone in Switzerland there are almost over 4,500 financial institutions that registered with the IRS and said we will implement and we will comply with the FATCA regulations. Worldwide, and you can retrieve this list from the internet, it's over 100,000 foreign financial institutions that registered with the IRS. I won't comment on the fact that, or on the question, if all of these foreign financial institutions will actually deliver data to the IRS. I doubt it. I personally doubt it. And if they did, I would question whether the IRS has the capacity to work on all this data. So potentially we are creating data graveyards here, but this is essentially what the IRS wanted. I would like to show you 4 world maps. The first world map is those countries which signed up for an agreement with the IRS. These are the countries that will implement FATCA. The yellow, so the solid yellow countries are those countries who signed up and ratified the agreement. The striped yellow countries are those who essentially signed up but did not ratify it yet. And the blue countries are those countries which operate under a Model 2 agreement. So pretty much you have covered the entire investment world. And these are the countries which will deliver data on their US taxpayers, on their US clients to the IRS. The second world map is the OECD Mutual Convention on Assistance, or the OECD Convention on Mutual Assistance in Tax Matters. You might not have heard about this. The OECD said when FATCA came out, this is a wonderful thing. We have been wanting this since decades. And all of a sudden, the US is inventing this kind of blueprint, this kind of copy for the automatic exchange of information. However, if in the OECD we want to have this exchange of information, we need to have a legal framework. And rather than having country by country negotiating this, the OECD thought, well, why shouldn't we use this convention and ramp up this convention in order to also embrace an exchange of information under the Common Reporting Standard. So basically all the countries that have signed up here, this convention, they declared that they will commit to exchange information once the automatic exchange of information is given and present. A subset of these countries is the so-called early adopters. Those countries committed to sign up to the CRS as soon as it is implemented, which essentially will be 2017. And the fourth world map is again a subset of these countries here, but with a little bit of difference. These are the countries which declared in Berlin last month that they will commence automatic exchange of information actually in 2017. So I think this really becomes a reality. And if you look at how the Common Reporting Standard is devised, it's basically a copy-paste exercise of FATCA. They actually took exactly the same text, they actually took exactly the same terms and definitions. They are talking about financial institutions, they are talking about non-participating financial institutions, they are talking about non-financial foreign entities, exactly the same language, save for the fact that they are not looking for, or obviously not looking for US persons, but rather, for instance, is Jochen Jaeger resident in another country? How would this standard, and you see the cover page here of a almost 300 pages booklet, which contains the definitions and the kind of modus operandi of the common reporting standard. How does that work? Essentially, it works like this. I've just taken the example of the Netherlands and Switzerland. So if you have a Swiss bank here, they would have to look at all their clients and establish if there is an individual person or if there is an individual person standing behind a company, just like FATCA, and that person is resident in the Netherlands, here in my example. And if so, they would have to ask this person, are you really resident in the Netherlands? And if this person confirms, then the data, the financial data about this person would be routed through the Federal Tax Administration to the Dutch tax office. And the Netherlands would exactly do the same. If you have a Dutch bank here, they would look at all their clients and establish if there is a person, either an individual person or an individual person standing behind a company. If this person is resident in Switzerland and they find indicia for this person to be resident in Switzerland, just collect the information and pass it on to the ESTV, to the Federal Tax Administration here in Switzerland. So basically, it's a reciprocity issue. The question is, on a political level, do we really want to have reciprocity here in Switzerland? And I think if I'm looking at the political climate in Bern at the moment, I'm not sure whether we will really ask for reciprocity. Why? And just allow me a very personal opinion here. I think in Switzerland we always have this notion we don't have any tax mitigation, we don't have any tax avoidance because we have a good understanding with the tax authorities, we have reasonable tax rates, so why should we avoid taxes here in Switzerland? I think the image is a little bit different if I look at banks which are quite near the border. You just have to go to Constance, for instance. And if I wanted to avoid taxes, which of course as a tax advisor I don't do, I would simply open an account in a bank in Constance, and there will be no reporting to Switzerland. There will not be even a kind of withholding tax in Germany. So I would get my interest 100%. So if I really wanted to mitigate and avoid taxes, I would go to this bank in Constance. Question is now, what happens if we all of a sudden receive information through this reciprocity that we actually have people who avoided or mitigated taxes here in Switzerland? Because I think that would probably spark the discussion of whether banking secrecy on a national level here in Switzerland is still valid. If I was a tax director for a canton, I would probably then go and say, well, I would like to have information about Jochen Jaeger, who is resident in Frauenfeld, but I don't get this information. So obviously there are some tax avoidance, there are some tax mitigators. Why shouldn't we try to abandon the Swiss banking secrecy on a national level? But that's a very political issue here. If you look at the timeline of the common reporting standard, and if all countries have signed up, those countries who have signed the early adaptation of the standard, they will begin exchanging information in 2017, which essentially means they have to collect and look at their clients basically in 2016, because 2016 is the first reporting period. Period on financial assets and financial income in 2016 will be reported in 2017 for the first time. Switzerland has, like Luxembourg said, we are most probably or will be lagging 1 year behind. So we will start exchanging information in 2018. Question is this a wise political decision or isn't it? I would be prone to say it's a wise political decision, and why? I think Switzerland is a country, due to its banking and asset management community, we have a lot of private banking here. And private banking in tendency collects more information than if you had a country with a lot of retail banking. I want to know, as a private banker, if my client has a holiday home in France. And I would probably like to have his telephone number here in France. Other countries don't collect this information, or at least more retail-driven countries don't collect this information. There are other countries, like Germany, like the UK, who are dearly seeking this information. And I think it may be a wise political discussion or decision to just wait another year to see if there is really reciprocity and if there are as many data coming into Switzerland as we are supposed to furnish into the foreign countries. I personally would doubt whether there is as much information coming into Switzerland if we really have reciprocity. My personal surmise is we will have a huge pipeline of data going into foreign countries, and we will have a very small kind of sewage pipeline coming into Switzerland in terms of the mass or magnitude of data. If you talk to representatives of the industry, they are of course concerned about the entire cost that these transparency initiatives entail. You're looking at all your clients, establishing processes and procedures for these things costs a lot of money, costs a lot of personal resources. But they are more concerned about their business model changing fundamentally. Why? And just as a little bit of discussion food here, you have legacy clients that are untaxed. I was told these situations exist in Switzerland. And the end game would be, I want to have taxed clients only. I want to have clients who can confirm that they are compliant with all tax regulations in their home countries. Now, there are two ways to achieve this. Either you have an exit program, you just tell your clients, non-tax clients, please leave my bank, or you make these clients go through voluntary disclosures. This is what is being currently done. And then at the end of the day, you only have tax clients. But what does that mean for your business model? And I think your business model will change fundamentally, because what happened if you talk to a client who you know was untaxed and you performed really poorly? The performance of the portfolio was poor. This client most probably just bites on his tongue and doesn't say anything, and probably he will say, Mr. Jaeger, it was really poor this year, but hopefully a little bit better next year. But this client is certainly not prone to suit you, to indict you. This client now knows you are in direct competition to a Commerzbank, to a Deutsche Bank in Germany. And the client will ask two things. First thing is, he gets a tax report from his bank in Germany, because the bank has to do that by law, and it doesn't cost anything. So this client will most probably ask the Swiss bank, you are giving me this kind of tax reporting, but how on hell, why do you charge me 500 Swiss francs for that? And the second thing is, the client will tell you as an advisor, as an asset manager, as a private banker, can we please talk about performance after tax? And that would probably mean your private banker needs to have at least a very good understanding of the tax situation of every single investment decision that he or she makes. What does that mean for a client resident in Luxembourg? What does that mean for a client resident in Germany? Because it may well be that you achieve a very good performance, setting a hedge fund, for instance. However, after taxes, the performance of a bread and butter plain vanilla fund, if you will, might have been better because there are higher taxes on the income emanating from a hedge fund. So your client advisor should be aware of that. And if the client, again, experiences a very poor experience and then says the portfolio yield was not as I expected it to do, he would be prone to go to a lawyer and says, please indict this bank. And he would even not have to go to Zurich or Geneva. He could do this under MiFID. He could do this in London, Frankfurt, or wherever he resides. And I think a judge in Frankfurt is likely to be less sort of amicable to a Swiss bank than maybe a Zurich judge would be. The other thing that we see is increasing risk, being sued, and increasing cost-income ratios. We are, in Switzerland, cost-income ratio-wise in the 80s, 90s% here in the private banking arena. In a retail banking arena where you have more automatic processes, like the UK, for instance, you're in the cost-income ratio of around 50%. So every pound or Swiss franc turnover costs you 50 cents or pennies in the UK as costs. And what does that mean? And this is something that we actually see happening now. We will see many more smaller banks trying to either outsource their compliance activities and give the information to somebody who is outside but does it on a bigger scale. Or we see smaller banks and asset managers gathering together, even merging. Or actually we see a lot of these institutions going out of business. And out of business could also be going into a less regulated environment. So we are talking to banks who envisage to surrender their FINMA license to essentially become external asset managers because they perceive this kind of field of activity is less regulated than I am under the onus as working as a bank. Let me sort of recap a little bit of time. You will be surprised if you read the Neue Zürcher Zeitung that we already have an automatic exchange of information in tax matters in Switzerland. I don't know if you know that. Switzerland is not only known, as we heard in the beginning, for chocolate, cheese, but also for wine. And in particular, the canton of Valais is known for its wine. The only thing is, or the only problem is that they currently have is the information about the surface where they grow the grapes sits with the cadastral office. The information how much wine is produced sits with the agricultural office. And the information about the turnover, the prices achieved, actually sits with the tax office. And they find it hard to reconcile these values. And what actually happens in the canton of Valais now, and I was surprised to read this in the Neue Zürcher Zeitung, they automatically exchange this information in order to see if they really produced as much wine as they made the tax office believe. Just to sum up, let me end with one quote. You know Hamlet. One of his friends said, "This may be madness, yet there is method in it." Looking at all the initiatives that we currently see and banks trying to reconcile these initiatives, I would probably be prone to say this. I hope I did not frustrate you too much. As an asset manager, you could probably say it's a matter of the banks. This kind of initiative or this kind of transparency initiative is a problem of the banks in the first place. But if you are an external asset manager, you will be faced with two questions. First question is, you are holding some information on your clients that you serve directly that the banks need. So the banks will turn to you and ask for this information. And the other thing, when you're an asset manager not having direct contact with clients, but just working for banks, the banks will most likely turn to you and say, could you please give me some indication of the tax consequences of your product which you devised in your shop, which you want to sell to the bank? And I think in the future, the discussion then will revolve around the question, who is going to pay for this tax advice? Because this tax advice is not for free, otherwise I wouldn't be standing here. But who is going to pay for this tax advice? Is it the bank serving the client, or is it you as an asset manager building a product and where the bank really asks you, can you please give us an indication of the tax consequences of this single product? Thank you very much for listening. I hope I stayed in my time.
Thanks very much. Yes. It's a fact that we are behind schedule, but it's not due to your presentation. But still, also, again, just one question, please, if there's anything urgent you'd like to know. Over there, one question.
Thank you. I have something urgent because you published yesterday a small article on the first Gruppenanfrage that the Germans did do in Austria. Now, what is your opinion on this, or the chances of this happening in Switzerland? Can you comment on this?
I think chances are very high. Probably the first country to come up with Gruppenanfragen or group requests or whatever you want to call this will be the US once they receive the information about recalcitrant or non-consenting account holders here in Switzerland. What I know is in Germany they are preparing Gruppenanfragen, for instance, on the basis, let me start in another way. In order for a Gruppenanfrage to be successful, you need to prove that it's not a fishing expedition. You know this topic. And how can you prove it's not a fishing expedition? You need to have some kind of behavioral pattern that shows there is tax mitigation or tax avoidance in the crosshairs. And for instance, one of the things that is being discussed in Germany is when the EU Savings Directive was introduced, there are certain products here in Switzerland which really yield interest, but they are carved out, they are scoped out of the initiative. For instance, if you have a certificate containing at least 5 bonds, this certificate, although it yields interest, is scoped out. And this is something that the German tax authorities are trying to play upon when they say, could you please give us the information of German resident tax clients who invested into this very product. And I think then you have this kind of behavioral pattern, and it will be relatively difficult for us here in Switzerland to say, look, this is a kind of fishing expedition where you just ask for random names.
Just to be more clear also on the retroactivity of this, because they go back to 2011, I think. Is this also something that is compliant with Swiss law and which we would accept?
I think it's compliant with Swiss law, yes.
Okay. Right. Thanks again, Dr. Jaeger. We are moving on with our next topic. That's actually FATCA and its impact on non-US funds. Therefore, I'd like to welcome Jonathan Tigerman, Senior Corporate Tax Manager at US Tax and Financial Services. I see that Darlene Hart is approaching the stage as well. She's actually the CEO of US Tax and Financial Services. As I've heard, she might join the presentation towards the end. I'm handing over now to Mr. Tigerman. Thank you.
Hello, everyone. It's very good to be here.